Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome to the show. Today's a special episode because we're going to go 360 with your money, and we're going to be looking at stocks, bonds, crypto, commodities, currency, and real estate. Now, these last few episodes, we have certainly focused in on real estate. So besides the equities that we'll discuss, we're going to point the listeners back to those episodes and they can listen in with what's going on in the real estate market. But there has been tremendous movement in the metals, specifically in gold and in silver. And I am joined in the studio today by Jason Riehl. Jason, welcome to the show.
Hey, Andrew, how are you today? Happy Friday.
Happy Friday to you too. We have a lot to catch up on, my friend. The markets are moving, and that it's always good if you are positioned properly. But let's start off with the metals because gold has made all-time highs, and silver for a while was hibernating, trailing behind, but this last week or two, it has caught up and it is now approaching those all-time highs as well. So the listeners don't have charts in front of them. And to try to just break down in simple to understandable terms what's happening with the metals market, share your 2 cents on why you think this major move is happening in both gold and silver.
Probably a couple reasons. Gold, I don't know if we know why it's moving up and making new highs. I think it's made 42 or 43 new all-time highs this year alone. You usually don't find out until after the fact why this is, tends to be a risk-off asset, but the market's moving with it. So one main reason probably would be that the dollar's been fairly weak over the last year or two. So that's usually drives people into gold if the dollar is weakening so they can hold on to their purchasing power. And one other thing in both gold and silver, I would say, is they've just been ignored for so long. In this last 8 or 10 years, so we've had this bull market. Gold's been holding up fairly well, but silver has not. But I just think with what's going on geopolitically, that probably has something to do with it. A little instability around the world, and then just also with our own economy, our economy seems to look good on paper, but then when you talk to people, other things are happening, and people are definitely putting their money in gold just based on the price action that's going on. So could be a multitude of things. Usually don't find out till after. So we'll just have to wait and see if silver can actually catch up to the all-time highs like its big brother gold is doing.
That's right. And there's tremendous volume. I mean, that's the indication for me that this is potentially going to continue long term. Right now, we have had what most people would consider a parabolic move. And there's been breakouts, there's been confirmations with the volume, meaning this is not light trading volume that's driving these prices. This is solid above average volume. When you do look at things like the relative strength index that is pretty high on the daily charts these days, right? You're over 70. Are we overbought is the big question, because I hesitate to encourage people establishing long-term positions when we've had such a big run. It's been incredible. Year to date, I think gold is up, 25, 30% already. And historically, that's very few years in the last 50 years where you had a 25 or 30% move. So how much is really left in this breath? Silver, the same. Usually you see silver outperforming gold, but in this case, gold really stole the spotlight. I mean, silver's up just a hair more, but it's with a lot of volatility, and gold just keeps climbing higher, higher, higher. So what are your thoughts as far as entry positions, and what are you seeing when you are checking out the charts as far as solid chart patterns?
Yeah, I'd have to concur with you as far as if someone's looking to enter the market, the metals market, or like you said, establishing a new position if they don't have one already, have a little patience. Because we have had that move. We've had a decent move, this year itself, like you said. And you want to have this on your radar. So we do get a pullback, so if you do see gold 2300, 2400, then that's a more reasonable place in my mind to establish a position. It may or may not get there. But the idea is, yeah, I think I agree that we've had such a move now, that having some patience. I think there's a lot more to go. So having you can get a better entry versus chasing this and you know getting knocked out of a position too early.
That's right. And let's give them some history in 2020, even as recent as the pandemic. Gold had a big move once the world shut down, and it was about a 6 month move. And after that, it really cooled its jets. As a matter of fact, it went into a sideways pattern for 3 years, from August 2020 of the peak all the way until just recently in the beginning of this year, 2024, where it actually broke out and went higher. So I personally took some chips off the table because I have been in the metals for many, many, many years, and it was a great run. And I thought, okay, we've had a parabolic move. Let me pull some chips off the table. I even had a conversation with Jason. We do this from time to time. It's like your counselor to say, did I do this? Was it premature? I know it's got more legs. And sure enough, within 48 hours, I was back in the game, and we had another run up. So that was good, and pulled more chips off the table. So sometimes, trying to time this stuff is so challenging. The charts will help. And certainly, based on your emotional makeup and your risk tolerance to volatility, you can make your own decisions. But what I've learned is you're never going to time the top. You're never going to time the bottom. If you do, that's God's blessing on that week of your life, because usually if you can scale in or scale out, you're going to do just fine. So if you've got a position that's had a good run, hey, there is nothing wrong with taking some of those chips off the table, because we are certainly at some form of a blow off top. But you look back in history. I'll give you another example here. Historically, if you look back after the 2008 crash, gold and silver had phenomenal runs between the lows of 2008 or early 2009 all the way to 2011. Gold was up 3x and silver was up 5x. That's 500%. And that was a multi-year run. That was a 2.5 year run. So the big question is, are we in the middle of one of those 2 to 3 year runs? And if we are, we didn't have the big shakedown like we did in 2008, right? And we'll see what happens with the stock market. We've got elections. We've got a lot of potential volatile things that could happen. That's what I'm looking towards as a new entry position. If we're in this multi-year run and we get a shakeout, or all of a sudden we get a 10, 20, 30% discount because of something that's happening in the equity markets, nothing to do with the metals, and everybody's freaked out of getting back in stocks or real estate, if those assets also go down, that's the sweetest part of the market, in my opinion, for things like precious metals. Jay, what do you see when you look at the multi-year movement of gold and how it's dressing itself up for potentially another multi-year run?
Right. No, I definitely, my targets are much higher for gold and for silver than they are today. But the path that they take to get there isn't it usually isn't straight up. And we've gone, like you said, parabolic quite a bit. For disclosure, I flattened out all my silver positions this Friday, and any of the miners I had, just because I was getting signals that's just a little stretched and there's not as much oomph. But back to the original questions, I do see this. I forget, there was something I listened to, but we spent the last 10 years putting money in zeros and ones and digits, and then we're gonna have the next 10 years are gonna put money into real, commodities and in the ground and the earth and things like that. Like the next leg of this bull run in the market itself. We'll have a lot more participation from the commodities. And you're seeing this now. This is, maybe we look back and we say, yeah, this is that, what a move that started. It seems, and things are pointing in that direction. So I'd have to say that there is time. That's so you don't have to race to get in. Know what your time frame is, and let the market give you some opportunities to get in. You don't need to chase it here, especially based on everything that, you've mentioned in this podcast so far, and what the charts are telling us, so.
And we're at the end of the third quarter at this stage in 2024. And with an election impending, with potential volatility, you can see a lot of moves and a lot of up and a lot of down. The key is really to scale in at an average price. I'm with Jason, full disclosure. I have removed my metals positions. And the reason I've done that, because I've been in this stuff for 8, 9 years, and I also have to raise cash whenever I see the potential for volatility so that I have something to invest. Because one of the learned lessons over the years of investing is that even if you can time the market and see the big trends, if you're not liquid when those opportunities present themselves, well, then you're in hot water because you're typically going to hold on to longer term positions. They're down now. You want to see them come back and rise, and you don't have any cash when things go on sale. So I'm raising cash for that specific reason. But I've also, as I mentioned earlier in the show, I've recognized that when I make a mistake, like I got out a little early a few weeks ago and I was crying on Jason's shoulder and said, "Hey, do you think this thing's got more legs?" And he said, "Yeah, check this out. Check this out. We're looking at charts together." And I recognized that, yeah, I'd pulled the parachute just a little early. And that's the beauty about liquid markets. The next day, I could make a decision and come right back in with my position. And we had another leg up, which is great. But that didn't change where my portfolio needs to go to have capital ready for some of the opportunities that I see in stocks and real estate and other things that have nothing to do with the metals market. So hopefully that has been encouraging. We do encourage all of you to dive into the technicals because at the end of the day, supply and demand, especially for metals, is dictated a lot by store of wealth and emotion and people's perspective on the general economies. And central banks play in this game too. So that's the other complexity. And take a look at the RSI, which stands for Relative Strength Index. Typically, when it gets over 70, that means it's overbought, and you're seeing those indicators. But also look at all the volume that's come in and do your historical analysis to see where it could potentially go. Because in 2020 and 2021, for example, you had a lot more volume than what we're seeing right now. So there still is the potential for the, say, big boys to step in and buy this up and see stratospheric prices in short order. It all is going to come down to, where the markets move these next few months. But anything else you wanted to add on this, Jason? Because I do want to bring the dollar into this conversation. The US dollar is at a very pivotal level right now, and that does impact gold and silver. One other note I'll just make, and if you want to address this as well, is copper. I mean, that is part of the metal complex. A lot of people don't talk about it, but it's known as the economic indicator. And copper got pretty much taken apart. It went down about 20% from the end of May, early June into the depth of August. But now the futures market's going the other way. I mean, it's really shot up, and it's something I would encourage people to pay attention to, because if the whole market gets sold off, if copper does retreat again and actually make new lows, that is a problem. I learned this lesson the hard way in 2008 and 2020 when I did own metals. Long term is when people decide to sell everything: stocks, bonds, commodities, real estate, just dump it all. Well, guess what? The metals go with it. So just keep an eye on that. But yeah, any thoughts on copper? And then let's roll right into the dollar.
Two things. First, just back it up a little bit to where you were talking about how you got out of your positions that you'd held for a long time. One thing that does do is when you do exit positions is you get a clear mind, because you no longer have anything at risk in those positions, and you can think a lot clearer. So that's one benefit. Like they say, you got to be able to sleep at night when you're just trading in general. So just as an investment or trading rule is, it's okay to get out of positions because it just clears you up. You have nothing dragging you or having any influence over what type of moves you make with your money. Because when you're out of position, it's still a position, but you don't have any influence. So it gave you the ability to get back in and then get back out. But I think that the sigh of relief that you pulled money off the table. Your plan, you were rewarded for your plan that you put in place years ago, is a very positive thing. So that's just on trading in general. Um, Regarding the copper move, it's interesting. A lot of news coming out of China. So if they're going to start throwing money around, it's interesting. That's going to another reason that might help out this commodity sector itself. And yeah, copper did make a nice move, but it's holding up where it should hold up in a nice uptrend. That's another thing when you're looking at the charts. This is where buyers should have stepped in, or where demand should have regained control, which leads back to the longer term trend, like we were talking about before. Is this a multi-year trend we're looking at here? It is now, but is it going to be multi-years in the future? And this is the type of price action that you would want to see in order to keep that case that we have a ways to go with this.
Spot on. And I appreciate the sentiments on the trading because that is exactly right. The clear mind allows you to really go back, take a new perspective, and then plan for the next set of investments. For me, it's a shopping list. What I do constantly, just like if I was going grocery shopping, I'm going to have a list of things that I want to buy that are not at the price yet that I want to buy them. And then I'm going to monitor those and watch whether quarterly earnings or the charts, or start to just gather more and more intel around those specific investments. And that's what I've been doing these last few years, getting ready. Now, I was blessed enough to buy several things on my shopping list in 2022 when we got that pullback in the equities. And it's been great. I bought Meta, Netflix, a few others of the Magnificent Seven that, as we all know, have done really well. And we'll talk about that in part two of this specific show. But moving to the dollar, Jason, I do want to bring this up, and I want you to educate the listeners a little bit of why currencies are so connected specifically to gold and silver, but really to all commodities, and the threshold that we're at right now, because we're at a pivotal level for the dollar. And the fact that the Fed came out recently and said, we are changing course on interest rates. We are going the other way. We've been hiking, and we're going to talk about the historical hikes that they've done over the last 10 or 15 years and how they do it in succession. They don't just do it once or twice and then move the other way. They typically do it like 6, 7, 8, 9, 10 times. This most recent move, I think, was 12 or 13 hikes in a row, and that was to the upside. But if you look even back to 2004 and 5, which led to the housing crisis, they had to curb that inflation that was going on. They moved rates up 17 times in a row. So when they reverse course, like they just recently did and said, we're going to cut rates 50 basis points, 0.5%, the dollar feels that. So go ahead and share with the listeners what we're looking at today with the dollar and why that's so important.
Yeah, it's interesting. I mean, if you look back, started in 21, that's, basically uh, after that's, our government injected, or the Fed printed, however you want to say it, a lot of money into the economy. So that was very attractive to our dollar and to other people around the country, because they knew that there was money coming to play and there would be expansion in our economy. So when the Feds are raising rates, it's very attractive, and it's a positive for the dollar. So the dollar strengthened greatly between 21 and 22. And then it has gone lower since then. When you look at gold and commodities and other commodities, the price of the dollar, or the strength of the dollar, has a inverse effect on it usually. Over the long run, it does. In short term, they can move in tandem or whatnot. But after we had that great injection of funds and the expansion in our economy from 21 to 22, and things heated up too much and they brought in inflation, then the dollar was sniffing out that there was going to be a course correction or a change in the Fed itself. So it's been trending down for 2.5, almost 2 years now. And you'll notice, if you look at the chart of gold, it's started to trend up nicely, and even more as this has been happening. So we're at a level now, to where we're basically back to the midpoint of where we've been for the last decade, as far as where the dollar is concerned. And rates have been low, and then rates have rates have been high, and now we're in that course correction where they're dropping rates now, and what they say is that lower rates is usually a weaker dollar because we attract less money if the rates are going down because you don't get as much return on your money. So the dollar is not as advantageous to investors, quote unquote. But it's interesting on a technical basis. Just we're bouncing along the bottom of an area that's been support since early 2022, and also even years before that, it was kind of a resistance. So we've broken through a prior resistance level. Now we're testing that area, which can be support. But the twist is that now the Fed's lowering rates. And if that lower rates, lower dollar rhyme continues to prove out to how it has in the past, then we should and most likely we'll see a weaker dollar over the next, who knows how long, year or two is what I'm thinking. And in that case, people, as the dollar loses its value or gets weaker, then that flows into hard assets and currencies and commodities, so they can keep their value. While the dollar is going down and they can put it in something that's going up, then they hold on to your purchasing power, which is kind of the key. But where we are now, we have a critical level, as Andrew was saying, around this 100, basically at 100. We're looking at just the US dollar cash. What is this? The futures are just the Forex. Yeah. So basically this week's low, it was poking, we hit 52-week lows a couple times in the last week. And now we're checking on 2-year lows. So critical, if this breaks below 100, the dollar on the Forex, then there's probably some downside momentum will pick up. And there could be a chance that we have, 2, 3, 4, 5% drop in the dollar, which will have an effect on equities and commodities, them both. So it's a level to watch, just 100 on the dollar and the Forex. We'll see what happens.
And I'm glad you brought up the global perspective to help the listener who may not quite understand what really moves the dollar. I like to break it down like this. If you're an international investor and you have to park your capital somewhere and you're looking at all 196 countries that are out there, you're going to park it where there's safety, where there's less risk, and you get the most interest. It's as simple as that. So the interest that we're paying as a nation is dictated by the bonds that we issue and also the Fed when they're moving those rates. But for now, as we all know, today I could park my money in the bank and get around 5%. That's great. No risk. Just put it in the bank and there's my 5% that shows up. And that's why we've seen such a strong dollar, because over this last couple of years, it went from 1 to 2 to 3 to 4 to 5%. Now, moving forward, as they've adjusted those rates and they're knocking them down to say 4.5, then 4, 3.5, then 3, we'll see. But they mentioned a target rate of around 3% in a couple of years. Well, that's going to get money out of the dollar. Because if euros or the Australian dollar or some other economy is still paying 4.5 or 5 or higher, then that money naturally will flow to those other countries. And that's what we saw happen in after 9/11 in 2001 and that crisis, and throughout pretty much that decade from 2000 till 2010, a lot of money flowed out of the dollar. And if you study your currencies, you will see the euro, the Australian dollar, the Aussie dollar, all the commodity rich countries, they had a good run with their currencies. I remember going to Europe and it was incredible. It was $1.50 for a euro. I was like, wow. And now it's almost at par. I think it's $1.10 or $1.12 today. But my point in all this is that historically, when they move these rates down, we do see a lift in all commodities. And that's what we're looking for. So if it breaks this 100 mark, going back historically to 2008, 9, 10, 11, when the dollar was really low, it was down at 70. So that's a 30% discount to its current value. So that can have profound effect. So keep your eye on the dollar. That's the bottom line. Now, I want to wrap this segment with the Fed funds rate, and then we'll continue our conversation. We'll get into the yield curve and we'll get into bonds in the next part of this segment. But with the Fed funds rate, which I find very, very fascinating, we've had these periods in history where they'll move, for a year and a half or 2 years, the rate's one way, they'll pause, Sometimes they have to continue in that same direction and then they will reverse course. So, for a quick history lesson, let's just look back at what's happened recently. So, 2022 to 2024, they were taming inflation. We all know that. Started in March. They started up with a quarter point hike and then they went, I think, 12 or 13 hikes in a row. They were aggressive this time. There was a lot of three-quarter point hikes, a couple half point hikes, and then it kind of tapered at the end. But essentially, they moved it from zero to 4.75 to 5. I mean, that was a big, big move. And now they've reversed course. So we got our first cut recently, and they've talked about those cuts, lasting 2 years. But let's look back before that, even before COVID. So before COVID, we were in a situation where they had boosted some interest rates in 2015 to 2018 to try to slow down some of the recovery. And it wasn't a big move. There's about 10, rate rises right in a row. But they moved from, again, we sat with those ultra low 0% Fed funds rates all the way up to about 2.25. So they didn't get too high. But then there was some softening and they started cutting. They cut three times in 2019. And then, of course, we all know what happened in 2020. And they got super aggressive and cut a full basis point or a full 100 bips, basis points, a full point, and another half point right after COVID happened. And that was an emergency meeting. They did that March 3rd and the 16th of 2020. So that was right back to zero again. So that's been the trend. And if we go a little further back in history, we can see what happened in 4, 5, 6. That was the housing boom. And then what happened when the whole market rolled over? How did they respond in 07 and 08? And in 05 and 06, they moved the rates up 17 times to curb that housing boom. So very similar to what we just experienced. We just experienced 12 aggressive rate hikes over the last couple of years. This one, it was 2004 to 2006. It was exactly 2 years and 17 different hikes, but they were very measured. They were all quarter point hikes. They did not get into the half point and the three-quarter point, which the Fed did this time. And we'll see the impact. Now, we all know what happened in 2007, 2008. The whole economy came crashing down because of these aggressive rate hikes. So the jury is still out right now on what the Fed just did. We haven't had enough time to see, did they land us softly into this new leg of the economy? Or in the next year, we're all going to be scratching our head and in a deep recession. Now, what happened in history in 07 and 08, in September of 2007, they had to start cutting rates. They started with a 50 basis point cut. Now, I'm not conspiracy theorist, but I will tell you it's quite ironic that on September 18th, 2007, they did a 50 basis point cut, and September 18th of 2024, they just started with a 50 basis point cut. So here we are nearly 20 years later on the same exact day. And what does the Fed know that we don't? Yet to be determined. But they did cut those rates for about 6 months. They cut substantially. There was a lot of half point and three-quarter point rate cuts from September 2007 till April 2008. And then that didn't do it. They paused for about 6 months. And as we all know, in 2008, the economy really fell apart in October. And they did some emergency meetings and they did two rate cuts in 2008, half basis point or 50 basis points, another 50 basis points. That's October 8th and the 29th. And then December 16th, 2008, they did 100 basis points. So that's when the world felt like it was falling apart. So it's a big question if we will see something similar. I certainly hope we don't, but history has shown this is the pattern. Now, Jason, when you hear this, being a student of the markets, what's your forecast of what season that we're heading into? Because there's been incredible rate hikes, which is good in one sense because the Fed has a lot of room to go down. They can go from 5 to 2 or 3, and there would be a lot of liquidity, we hope, that would be injected in the market. But now that you've heard this history, what are your thoughts, and where are we headed from here?
Yeah, they say history rhymes, but it doesn't repeat, which is a which makes sense to me, and it's interesting. You talk about 2005, 6, 7, and 8. the way that they raised the rates. And then if you go back to that 2000, 2007 and 8, even though they were lowering rates trying to stimulate the economy, the cycle wasn't going to have it. It didn't matter that you could borrow money because people weren't borrowing money. It didn't matter they made money cheaper because people didn't they were running out of gas. There's been a lot of anecdotal and real evidence that the economy has been slowing this year, hence the rate cut from the Fed. All year long, numbers are not looking good, even though, inflation coming down is positive because prices, for prices and things like that. But also a drop in inflation can mean that, activity slowing down too. So the way it's lining up to me, I would just, prepare for the worst, hope for the best. It's been a while since the economy's contracted. And there's, I don't think cycles are non-existent anymore, and the Fed's there to make sure. I think that they do still exist, even though they say the opposite. So I would just prepare for the worst and hope for the best now, and just be open to all possibilities, and just because you don't know, you can't tell the future. You don't know what's going to happen. But if the Fed's lowering rates by 50 basis points, like you mentioned before, what do they see that we don't see? You know, um, and also that, keep an eye on the employment numbers. That's a big signal of what's going on. But a lot of different things I've read and I've heard, from credit card delinquencies, the amount of revolving credit that's out there hitting new highs, auto loans. Like, there's small things, employment ticking up. There's a lot of small things that could just be a blip, or could be the start of something bigger. So we'll see.
You got it. And the word to the wise is simply this: raise some cash and be prepared, because the best buying opportunities always exist. Sadly, when there's blood in the street and people are panicking. So when there's panic, that is opportunity. And if you built that shopping list and you know what you want to own and it's selling at a discount, you have to hold your nose and go underwater and have faith that if you're buying something solid, which I prefer to do during these pullbacks and crazy volatile markets, I like to go find companies that I know they're not going anywhere. They have incredible balance sheets, lots of earnings, track record and history of publishing incredible gains, but they're just on sale. And I look for those moments I referenced earlier, and we'll get into this in the next segment about the indexes, that I had purchased some things in 2022 just because for whatever reason the world freaked out that summer and into that fall. And okay, great. All of a sudden, I had things like Meta and Netflix that were selling at half off their peak price. And I thought, well, these are solid companies. They're not going anywhere. I'm going to park some capital there. And today, those positions are up 2x, 3x, 4x. It's incredible how, in a short period of time, things can change. So, with that said, we hope the message blessed you. Jason, any other thoughts before we wrap this? We're going to continue next week with our conversation on the yield curve and the indexes and commodities. But any other thoughts as we wrap?
Yeah, just to piggyback on that, blood in the streets, another, as far as anecdotal stuff, if people want to do a little research and just read up on what Warren Buffett's been doing this last year. I think he's got in his fund, the Berkshire, they have their largest cash position they've ever had. So that's, I think, I don't know if he said it, but he likes to say, when the tide goes out, you can see he's not wearing the shorts or whatever, So if one of the best investors in the last century has his largest cash position he's ever had, that could be a signal. So just something to think about, and maybe do a little reading up on what he's done this year so far.
Absolutely. And that is a signal, because Berkshire Hathaway is sitting on $276 billion. That's a lot of cash. And the company, as I recall, is just shy of $1 trillion market cap. So, I mean, when you start talking about the book value and a quarter of the company's value sitting in cash, he's raising it for a reason, and that is to go buy some discounted assets when no one else has cash. So we'll catch you on the next episode as we continue with part 2 of our 360 series, going full circle with your portfolio.